And despite some wild swings in the markets lately, the Federal Reserve remains steady and upbeat. The Fed's so-called Beige Book survey of economic conditions around the U.S. showed moderate growth in all 12 of its banking regions over the past 6 weeks, with the overall economy getting a big boost from housing and strong auto sales. The central bank also said the economy performed better during March than the month's weak jobs report and the dip in retail sales would indicate.
But that report didn't do much to boost investor confidence today, and the market's gyrations have created confusion for investors. Do I stay the course, sell, or is now a good time to buy? We turn to Sara Malik for guidance. She's the head of global equity research for TIAA-CREF. It manages $500 billion in retirement and other assets. Sara, thanks for coming here.
Thank you.
Welcome. I mean, this is a very confusing and nerve-wracking time for investors trying to navigate through all of this. So how do investors sort through all of this information?
Well, we're dealing with a lot of noise right now, and just this week we've dealt with a lot of volatility. Just China GDP came in below expectations this week. We also had to deal with a decline in oil prices, and earnings have started out quite rockily. So what we're trying to do is look through some of this noise and focus on finding stocks that can do well for the long run. An example of that are companies tied to the housing market, such as Realogy. Realogy is a company that owns some of the biggest brokerage platforms in the country, such as Coldwell Banker and Century 21. And they're going to do well as housing prices and transactions continue to do well.
So you're always looking for the mega trends. You're not looking for next week's opportunities. You're looking at the long-term overall picture. Do you feel housing is recovering? What about energy? Do you think the prices are generally headed higher or lower from here?
Well, commodity prices are suffering right now, and a lot of that has to do with some of the problems that China's having. GDP is coming in under expectations, and they're also dealing with inflation bubbling up. So we're focusing more again on companies that have their own levers to pull. And one company we like a lot is Time Warner. This company is doing really well because they own great brands such as HBO, which has Game of Thrones, which is a great show. And they also have a great movie franchise with the Hobbit franchise coming out and the first movie doing over $1 billion at the box office.
Now, I understand you're not a real fan of technology stocks, although you have some in your portfolios. But when investors see these headlines about tech stocks are really hammered, or the news today that Bill was reporting about on Apple, that the stock is trading really low now, around the $400 range, there's this urge to say, this is a bargain, this is value, and should I buy it? How do you advise investors to examine and digest this information?
So technology companies are struggling right now because companies are reluctant to spend on technology because of macro uncertainties. There's also new structural trends going on in technology, such as cloud computing. And we're looking at companies such as Amazon that have a web services business and also can dominate the retail area.
You look globally. Where besides the U.S. do you like? I mean, Japan's been very aggressive with their monetary policy this year, and they've been a stellar performer overall as a market. I keep hearing about Mexico. A lot of smart money is going to Mexico right now for various reasons. Where do you like right now?
Well, we're looking for companies that can do well because of their global industry. So, for example, you can go to Europe and look in the global pharmaceutical sector. And Novartis is a great company there. Global pharmaceutical companies in general have great pipelines. Novartis has a great product outlook. Their products are already approved by the FDA, so that takes away a lot of the risk. And they have a rock-solid dividend yield at 4%.
Do you like them because they're a European-based company, or just they're in the right industry right now?
We like them because they're in the right global industry.
Is there some trend or something you're seeing out there that investors are missing out on? What should they be paying attention to?
We think investors should be paying attention to two powerful trends going on in the equity markets now that should support the markets for the long run. One is that stock correlations are declining. This means we're moving to a stock picker's market. You can do your homework, find the companies that are mispriced relative to their free cash flow that will do well over the next cycle. The second is equity inflows have turned positive. This is after 5 years of fairly negative inflows, and that's another data point that will support the stock market.
And a big guessing game right now is when the Fed will start to gradually pull back on all of the liquidity it's been adding to this market. When do you think that'll be?
Well, we're watching jobs to figure that out, and jobs claims have been a little bit rocky recently. The payroll numbers were also weaker in March, and we think as long as the jobless rate remains up at the 7.5–8% range, the Fed will continue to implement QE3.
Sara, thanks for coming by. Really appreciate it. Sara Malik of TIAA-CREF.